Hey folks, welcome back to the channel. This is Jason, host of Fighting Words Financial. And look guys, it's time to start talking about stocks that are overvalued. And let's talk about why that is. Look, I see some risk in broader markets right now, of course, but I see a lot of risk concentrated into a few stocks across the stock market. And I'm going to be talking about a few of those over the next couple of weeks. Now, it's in no particular order. But I did want to talk to you about Airbnb today. And I want to be upfront and clear. I don't think Airbnb is a trash company. In fact, I love the concept. I've used them before. And I don't think that the company is going to crash and burn. I just think that it's overvalued in the old style sense that it's overvalued. And investors that are buying at today's prices are probably going to be disappointed by performance. So now, they just recently had their IPO. And it's not uncommon for a fresh IPO to not be profitable, or even in the case of a lot of these SPACs lately, to not have any revenues at all. Now, I am really kind of worried about a lot of those, but I'm not really worried in that sense about Airbnb. But I do want to say that the lack of profitability really can't be ignored at this point. Airbnb isn't just some young company that's going public and then pouring all of their IPO proceeds into business expansion or scaling production. Now, Airbnb is not like that. It's a very large and relatively mature company founded in 2007 with listings globally, and they're still not profitable. They already actually seem to be at scale. They're already the biggest alternative booking platform in the world for travelers and vacationers. They've got listings in 100,000 cities and towns, all throughout 220 countries worldwide. Now, you can put that size in perspective if you compare Airbnb's market cap to some of the big hotel players out there, some of these large hotel corporations. So Airbnb has a $93 billion market cap at today's prices. Marriott, for example, has a $41 billion market cap. Hilton has a $30 billion market cap, and the Hyatt has a $7.5 billion market cap. Now, I wouldn't call these companies exactly direct competition with Airbnb, and let's say yet, because a lot of these companies are looking to get into the home rental sharing game too. So a hotel stay, though, and an Airbnb type stay really are just two separate things in my opinion, and they're not directly comparable. And that's not necessarily why I'm making that market cap comparison at this point. What I really want to do is just say that the comparison with Airbnb just kind of shows how irrational it is right now. I'm making this comparison because those companies have a massive portfolio of physical assets. They have an online booking platform, and they have a very successful brand loyalty program, which really can't be discounted. And they do already have partnerships, like online booking partnerships with timeshare owner platforms that have functioned for a long time in a way similar to Airbnb. They just really haven't concentrated on that stuff yet. So the point is that owning these physical assets, while yes, it is a double-edged sword, you now have to have all these hotels that you need to maintain and run. But those hotels also allow you to benefit from economies of scale, which lead to better margins than your smaller competitors. So here's what's going on now. Many of the traditional hotel brands are looking to get into the home rental game, the temporary Airbnb type, small scale home rental game. And they don't really have to be enormously successful at this business in order to hurt the bottom line of Airbnb. The nature of this business is that homeowners that use Airbnb or any other service to temporarily rent out their home, these guys are economically driven. The real estate and the location are controlled by the individual. All of the maintenance and expenses and most of the liability falls on the homeowner. It only stands to reason that the homeowners are incented to rent out their home to whichever platform gives them the biggest cut of the rent check. Right now, that's Airbnb or Homestay or HomeAway. That may not be the case in the future. All of these hotel chains looking to get into the business, all they have to do to harm Airbnb is really to break even on their vacation rental listing whatever they put together through whatever platform. And every rental that goes through their platform is one that doesn't go through Airbnb. There's going to be inherent price competition between Airbnb, HomeAway, the traditional hotel brands. They're all going to be getting into the game, and because of the relatively low technological barrier to entry, a whole host of new well-funded entries are probably going to start popping up. This is particularly bad for Airbnb. I don't see that Airbnb has inspired any brand loyalty from either its guests or its hosts. And simple economics is going to dictate where hosts list their properties and where guests rent them. The hosts are going to go where the percentage of the cut they get is largest. Right? The rising competition, which I see as destructive competition for companies like Airbnb and HomeAway, is continually going to squeeze the cut that Airbnb and HomeAway can take from their listings. So being a relatively mature software company that really only offers listing space for homeowners and a few other ancillary perks, they're really probably already close to the limits of margin improvements that they can make. And they're going to be looking to add value to their platform in the form of new service offerings, which may raise costs and not necessarily improve margins. Companies usually start that process and to some degree don't even have that realization until their core business begins to develop positive cash flow. Airbnb is not doing this. They don't have positive cash flow. Let's take a look at Airbnb's profitability so far. In 2019, the company lost $486 million. In 2020, on $3.6 billion of revenue, Airbnb lost $650 million. Now, one, of course, could say that the $650 million loss over the trailing 12 months was pandemic related. But even in 2019, on even more revenues of $4.8 billion, Airbnb still lost $486 million. So like I said before, guys, I don't think this is a terrible company. I don't think it's trash. I don't think they're going out of business. But I think that folks are going to be disappointed by the future long-term performance of Airbnb stock. There just isn't a reason that a listing platform for home rentals that had $4.8 billion in revenue pre-pandemic and $3.6 billion in revenue over the trailing 12 months should be worth their $93 billion market cap. That pricing means that in order to grow into this $93 billion valuation, Airbnb not only has to multiply its revenues many times over, it also has to find a way to dramatically improve margins. Either that or the price simply has to come down, and I'm betting that that price is going to come down. So growing revenues and margins to that degree is going to be difficult without competition, and it's going to be extremely difficult with competition. And let's face it, folks, competition is coming. The current lofty price of Airbnb already has baked in expectations of future success that may not come in the form of growing profits. I don't think that investors buying at today's prices are going to be properly compensated for that risk, and I think they're going to end up being disappointed. I do want to disclose at the end of this video, guys, that I don't have a position in Airbnb. I'm not planning to start one unless there is a dramatic reduction in share price. But this is just my opinion, folks. You can feel free to disregard it. Don't accept this as instructions to buy, sell, or hold any security. And as always, if you think I'm wrong, feel free to let me know in the comments below. I look forward to hearing from you guys. Thank you and have a nice day.